Now, that interplay between inflation, interest rate and economic growth is also likely to determine the global asset class returns that we'll see this year. In the absence of further energy supply chain shocks, it seems likely that global inflation might fall in 2023, and that, of course, might be led by the United States. Herman van Papen-dorp, Head of Investment Research and Asset Allocation at Momentum Investments, joins us now to unpack this further. Thank you very much for joining us this evening. And I think it's one of the big questions that everybody is looking at the financial markets and thinking, what is likely to happen given all the turmoil that we saw in 2022? There is an indication by the reporter or the note that was put out by Momentum Investments that we might see a slowdown in all of those huge shocks that we saw last year. And maybe if you could start by unpacking the reasons for that a little further.
Yeah, good evening to you and to all the viewers. I think what we're looking at this year is maybe a bit of a lackluster start to the year, very much in the same vein as last year, where markets might still be under pressure for the early part of this year because of all the remnants of all the factors that really put markets under pressure last year as well. Because we're still dealing globally with high inflation rates. Yes, they are coming down, but they're still high. We're still dealing with interest rates going up internationally. We're obviously also dealing with local interest rates going up as a sort of relayed factor relative to the global outlook. So these kind of factors will probably keep markets under pressure in the early parts of this year. Obviously, we're also dealing with, you mentioned earlier, South African recessionary issues. But I think if you look globally, there's still a lot of uncertainty in financial markets about whether we're going to see a full-scale global recession. And if we do see a recession globally, how severe will that recession be? How long will it last? And when will we eventually see the likelihood of some interest rate cuts starting to come through internationally, which could have a bit more of a positive bearing on markets? But for the first part of the year, as markets grapple with, the last phase of interest rate rises, as markets grapple with the likelihood of recession or not, we're likely to see significant volatility in markets and maybe some downward pressure on markets, maybe for the better part of the first half of the year.
And what does this mean for the different asset class returns that investors would hope to be getting? We have seen that a lot of the listed companies, whether it be here in South Africa or abroad, have come under some huge pressure because of the shocks that you just broke down to us. So when we're looking at returns on different asset classes, how are we looking at?
Yeah, I think the first thing that we have to say is that this kind of backdrop of the probability of recession and the likelihood of further interest rate increases globally is not something that's good for growth assets. So assets like equity and global property will probably be under some pressure in the early part of the year, fundamentally because of these kind of factors that I've mentioned earlier. So again, if you look at the relative valuations, I think there's where South African assets look significantly more favorable. If you look at South African equities, they're trading at one standard deviation cheap levels relative to emerging market equities, the sort of peer group that we operate within. Even more so against developed markets, we're looking much more attractive there as well. So at least we have some margin of safety on South African equities, which is not the case for global, particularly US equities. So again, from that perspective, it should be no surprise that in the last couple of weeks, we've actually seen the South African equity market outperforming global equity markets because of this margin of safety valuation underpin that we have locally. And then if we look at South African fixed income assets, they're also looking quite attractive on a real basis. I mean, if you look at where our inflation rate is and where our bond yields are, at the moment, we are looking attractive relative to other emerging market fixed income nominal yields. We're also looking very attractive relative to developed market yields, which are still predominantly in negative territory because of, yields being significantly below current inflation rates. So I think the South African asset class range looks much more attractive to us at Momentum Investments relative to the global asset class picture. I think that maybe the one exception is that global bonds are starting to look a little bit more favorable. I think, in time period since the global financial crisis of 2009, we've actually seen global bonds not being an attractive asset class for fund managers in totality over that time period. But we're starting to see a little bit more interesting levels after the significant sell-off we saw in global bond yields last year. That maybe this year we're going to see some more positive returns from global bonds as well. But global equities likely to be under pressure for at least the first part of the year until the markets start looking through this recessionary kind of probabilities into an environment where maybe at the beginning of 2024 we might see some interest rate cuts coming through from global central banks, which will alleviate some of the pressures on these global growth assets like global equities.
Yeah, and just focusing on the local market for a moment, Herman, does it focus on just the global incidents that you've just mentioned or that we've just been discussing, or do they look at the local factors? And I'm talking here specifically about the issue around the power crisis that we have. Or has the market relatively priced that in terms of we know South Africa has a power issue, and so it's not the big thing that will move any of the asset classes or any of the other equities that you were just breaking down for us?
Yeah, that's a great question, because what we need to remember is that, we are part of the global framework. So I would answer your question directly by saying global factors are more important for South Africa than local factors. Also because if you look at the South African earnings base of our local companies on the South African Stock Exchange, it's only about 30% of the earnings that really comes from South Africa. The rest, we are having global companies that have got nothing to do with what's happening on load shedding in South Africa or the logistical problems of Transnet or so forth. I mean, so I think, predominantly global factors drive the local market. And then it's only, secondary in a secondary phase that we're actually seeing local factors like the Transnet logistics that are particularly relevant for the commodity sector, for instance, in South Africa, that will play a role. So it's really the global framework. But I think if we look at the kind of valuation underpin that we have from South African equities, then we can at least say, when global markets go down, we are likely to go down probably less than they do because we have that valuation underpin. And then when they do recover again, eventually, then we should see a significant risk-on event, which really will unlock that value that's pretty evident in South African equities in that kind of time frame when we start to move to the latter part of 2023.
Thank you very much for those insights, Herman. That is Herman van Papen-dorp. He's the head of Investment Research and Asset Allocation at Momentum Investments.